back on Morning Movers with another look at Oracle. That stock is higher in the pre-market, adding to the more than 30% rally we've already seen this month. The U.S. and China making progress on trade talks with China over the operations of TikTok. CBS News is citing Trump administration sources that Oracle could play a key role in any deal. Treasury Secretary Scott Bessent saying today that President Trump's willingness to let TikTok go dark motivated China to make a deal. Time now for Options Corner. Joining us to take a deeper look at this chart, we've got Rick Ducat, the Duke of Data himself, lead market technician here on Schwab Network. All right, let's talk about the trends in this chart for Oracle.
Yes, good morning. And we can see here Oracle, the obvious outperformer here versus the sector, the tech sector, and the S&P 500, up more than 77% during the past year. Tech is a sector with very clear winners and losers, though. And for the most part, the software sector, of which Oracle is a part, has not really been doing all that well. You can see IGV, the yellow line, our software sector ETF, up about 28%. But then you see the names like Autodesk, Salesforce, Adobe, all down pretty significantly here. So Oracle's kind of one of the big bright spots here, and what really drags up the overall average for the sector. Palantir, you can see, really starkly outperforming everything in its path here. But to look more closely at Oracle, a big, large move to the upside on earnings here. Very heavy volume, too. High volume, big jump up, shows high conviction on the part of traders here. Now, price has retreated somewhat from these old highs that we made during the earnings jump up near 346. Now we have hit a low point here near about 292. So these are the boundaries to watch in the short term for further breakout activity potentially here. RSI interrupted here. We have backed off from that overbought area and broken through our green trend line here. So perhaps a bit of a slowdown in momentum was taking place here. Now, when we look at our volume profile and standard deviation channel studies, we can see that there is a slight volume node here around that 310 area. So a move back above 310, above this volume concentration and above our relative highs there from a couple days ago, or a couple sessions ago, excuse me. 310 would be a notable area to watch out for to the upside. To the downside here, 291.75. That's our low point here, but about 292. That lines up with our +2 standard deviation channel here. So that could be a further supportive area. And failing that, though, the gap 260, the old high points, and our 21-day EMA line up together around that general area.
All right, thank you, Rick. Now, to take us through an example trade, we've got senior options contributor Tom White and co-host of Fast Market. All right, Tom, how would you set up an example trade on Oracle? I mean, it's like Rick made all the points. It's been outperforming its sector, outperforming the S&P 500. What's the approach now?
Well, you start taking a look at volatility levels. Typically, when you see a stock hitting all-time highs, volatility starts to come down, right? There's a lot less uncertainty. Well, in the case of Oracle, after hitting those all-time highs last week, we had a couple down days. Now the stock's starting to resurge to the upside, up about 4 or 5% today. But implied volatility levels are still elevated at this point. The IV percentile rank above the 65% level. So we're in the top half of what we've seen implied volatility levels over the last 52 weeks. So that kind of gives you the dilemma. Which way do I look at this? If I'm bullish on this name, do I buy a call vertical? Do I buy a straight call? Well, you can, but with higher implied volatility levels, it's going to cost you more. You're going to have more at risk. Maybe the risk reward doesn't set up well. So I looked at something a little bit more passive, a little bit more conservative, where I'm going to sell an out-of-the-money put vertical for that neutral to bullish stance, where I can still give myself a little bit of a cushion to the downside before I start getting hurt on this one. Really short-term positioning I'm looking at here out in the October 3rd weekly cycle, so just 17 days to expiration on this short put vertical. We're going to sell the out-of-the-money 310 strike put and buy the 290 strike put, so a short neutral to bullish $20 wide put vertical. You're going to collect roughly, if the stock opens up here around 315, you're probably going to collect $5, maybe a little bit more than that. But the credit that you collect is what you can make on this position, $500 per spread with $1,500 in risk. But you've got better probabilities of success. That 310 strike, you got a probability of about 55, 56% that it's going to be out of the money at expiration, which is what you want on this type of trade. You want it to remain above 310, and then you get to keep the credit in 2.5 weeks when it expires. Your break even goes down to 305. That's just over 3% below that 315 level that we're going to open up here at this point. And as I mentioned, when you've got more risk than reward, there's always the trade-off that, well, I've got a better probability of success because I could buy a call vertical that's at the money, and if the stock just kind of remains here, you're not going to make money on that position. So you have to start looking at those implied volatility levels to make the decision on which strategy to use based on what your assumption is for the stock over that specific duration into expiration.
All right, thank you, Tom. That's an example trade there for Oracle shares moving higher once again in the pre-market, up more than 4%.